So a warm welcome to you all. This is the second of our NED network series. I'm Fiona Bell, I'm a partner at RSM and I lead the national share schemes and reward teams. Today, we're going to be exploring the challenges of driving performance through incentivisation. So I really do appreciate you all sparing the time to join us for this discussion, and I was absolutely quite thrilled to see a number of names on the list of participants that I know, and I'm also delighted to have the opportunity to meet you, who I don't know, although of course it is rather remote. Having said that, the joy of a webinar is that we can accommodate a lot more people than we could do squashed into a meeting room. So we've had a large number of sign-ups. I know that not everyone will be able to join us for the particular event, but it may well be that people will be looking at this by way of a recording later on. But this is a real interest area for many people, and particularly those who are non-executive directors. Sir Andrew Lyckerman, who amongst many other things was the Dean of the London Business School, once said that the measure of management success is surely not just to have done well for shareholders in the past year, but to manage in a way that places the company to do well in the future. And so taking that into account, NEDs and REMCOMs and nomination committees must look to structuring incentivisation to drive continued or renewed performance. It is an important topic. But let's start off with the requisite housekeeping issues. If I can move on the slide. Everyone is going to be muted, so you don't have to worry about dogs, children, or simultaneously watching cricket. Slides will be circulated and the webinar will be recorded. And please be aware that this is a series. It's part of a series, so do look for the NED network button on the RSM website. Sign up if you're not already signed up, and do let us know if there are any particular topics of interest you'd like to be discussed further that are particularly important to you. So, moving on, if I can then introduce our panel. It is with pleasure that I'll start off by, sorry, I do have to go back one, don't I? There is a Q&A functionality, sorry, I forgot to mention that. Now, you should on the right-hand side of your screen see something that says Q&A with a downward button, and if you, or an arrow, and if you click on that, you'll be able to then pop in questions. We will be looking at all the questions as we go along, and I will particularly come to these Q&A questions at the end. If, however, I think that a question is particularly pertinent to some of the other points that we're going to be discussing, I'll bring that in at that stage. So now it's my pleasure to introduce our panel. So to begin with, Martin Cooper is one of my partners and he specialises in reward and advising remuneration committees. So Martin, would you like to say a little bit more about yourself?
Sure, thanks Fiona. So as Fiona said, I'm a reward and incentives partner at RSM based up in our Manchester office. I advise private and listed companies on a whole range of their remuneration and reward issues, so putting in place long-term incentive plans, as well as short-term plans, and also advising on the issues around reward on a transaction.
Thanks. Thank you, Martin. Now over to Richard. Richard Day is the non-executive chair of Pilatro and Eden Geothermal Limited, and also one of the writers of the QCA, that's the Quoted Companies Alliance, Remuneration Committee booklet. Martin, Richard, would you like to say a little bit more?
Yeah, thank you, Fiona. Yeah, really pleased to be on the panel today because I think remuneration is so important to maintain momentum at companies. I suppose I'm a little bit of a poacher turned gamekeeper, or gamekeeper turned poacher. I'm not sure which. In that I I spent 25 years as an advisor on the equity capital markets with the broking firms, and then about 6 years ago I moved over, and so have direct experience of advising and you know, helping on the other side, but also now in my role as chairman, also having direct experience of trying to set appropriate remuneration structures. Palatro is in the technology space, mobile technology space. That's listed on AIM. It's only a small company. Eden Geothermal Limited is in the private space. We've got funding from government and from infrastructure, private investors as well. So I think there's a pretty broad range of trying to satisfy various interests on those. And as Fiona said, I was also on the QCA. We wrote we're involved in writing the new REMCO code, which had a lot of input from the investors as well, which I was pleased to be able to share in. Thank you.
Thanks, Richard. And now James. James Gregson is a Senior Investment Director at Palatine. And so the great opportunity here is that he is going to be considering incentivization from the perspective of the investor. James, would you like to say a little bit more about yourself and perhaps about Palatine?
Yeah, sure. Thanks, Fiona. As you said, I'm James Gregson. I'm a Senior Investment Director at Palatine, where I focus specifically on investing from the impact fund there. That's a £100 million fund that we raised in 2017. Investing in companies that make a positive difference to society and/or the environment. So my role at Palatine, I sit on the 4 boards as a non-exec director, where clearly they have an important role in the incentivization strategy of those companies, and work with Martin and the team at RSM on doing a lot of that. So it'd be great to be on the panel today, and looking forward to the discussion.
Super. Thank you very much, James. So now I think I'm going to pass over to Martin to introduce this session.
Thanks, Fiona. So we're going to devote most of today's session to a panel discussion, a Q&A, where we'll talk about various issues relevant to non-execs in particular in their roles surrounding remuneration. But what I'm just going to do just for 10 minutes before we get into the panel discussion is give really an overview of what I think non-execs should be thinking about when it comes to remuneration, how they can approach the issue. I'm going to talk through why, or indeed if, you should be incentivizing people in the businesses you're engaged with, what you should be incentivizing them to do, how you can go about incentivizing them, so what structures you might use, who you should be incentivizing, and then what quantum, what size those awards might be. So if we start off with why you should be incentivizing your people, it's not a given that we should do incentives at all. There's quite a lot of conflicting research on whether incentives are effective at driving behaviours. But I think the one conclusion that does come from the research in general is that for an incentive to be effective, it has to be very targeted, very focused, it has to be communicated well, and that can then have the impact you're intending. And the purposes really of incentivization always comes back to recruitment, retention and performance. So being able to get the right execs into your company that have the right skill set. A lot of execs these days have already quite developed ideas about what they want in terms of equity, what they want in terms of their bonus plans, and you need to be able to respond to that and to make an appropriate offer. When you've got the right people in, then being able to retain them. Long-term incentives are a powerful retention tool, particularly when they have forms of tie-in or deferral, and are often used in that way. And then thirdly, the purpose of incentives is to drive performance in a business, which leads on to the next point around what should we incentivize them to do. It's all very well saying it's to drive performance, but how that is going to be reflected in each business is completely different. And here I think is one of the first areas where we can make a distinction between private and private equity backed businesses and listed businesses. And I know in the audience today we have people from both of those camps, and indeed quite a lot of people who sit in both. In the private and PE-backed space, very often an incentive, a long-term incentive, is structured around achieving an exit for the shareholders, achieving a sale of the company or an IPO, and then maximising the value of that exit. That's not always the case, and some private equity, well, less private equity, but some private companies, exit is not the objective there. And so there may be other performance conditions around profit or earnings per share, dividends, etc. But exit is the most common route in a private business. In a listed business, it's very different. Obviously, exit's not the purpose. So listed businesses need to think quite deeply around what are the appropriate performance conditions for them to apply to their business. And we'll talk a bit about that later, both financial and non-financial performance conditions. But almost invariably, listed company incentives will have performance conditions attached. One of the rare exceptions is a VCP, a value creation plan, which is a fairly significant number of listed businesses have now, where that's about rewarding transformational growth in the share price of the company. Now, whether it's listed or private, it all comes back to investor alignment. So when we're thinking about what we want to incentivize the workforce, the execs, to do, it's essentially about achieving what the shareholders' objectives are. And in a listed company, that might often be total shareholder return. In a private company, it might be achieving that exit. So it really is thinking about what is the business trying to achieve, what do the shareholders want it to achieve, what do the employees need to do to deliver that, and then how can we structure an incentive that's going to help incentivize them to do that. In terms of how we should incentivize them, the structure really. For short-term incentives, almost invariably it's cash. You occasionally see other structures, but rarely, and it's often not a good idea. So short-term annual bonus plans, nothing particularly complex in the structure, although they still need thought around the commercial way in that operates, the way in which that operates. Long-term incentives, there's much greater range of structures that we see. Again, private and listed, a bit of a distinction here. In both, you can structure a long-term incentive as cash, although the flexibility and ease of implementation you get from cash, it always needs to be traded against the very high tax costs. Everything's going to go through income tax and be subject to national insurance. So in the private sphere, various government-approved share schemes are often used. So EMI is the one I've mentioned there as the go-to scheme for SMEs. For companies that don't qualify for that because they're too large or don't meet some of the other tests, then there are other HMRC-approved schemes such as CSOP that can allow you to structure your long-term incentives in a tax-efficient way. For companies that don't qualify for those at all, and that would be the case for most PE-backed companies, certainly almost all PE-backed companies where the PE house has a majority stake, to achieve a long-term incentive plan in a tax-efficient way, you're going to be looking at issuing equity to the employees. That might be ordinary shares, or more commonly these days, it's growth shares. So a class of shares where we have a hurdle and the management participate in value growth above that hurdle. In the listed company sphere, there's an overwhelming majority of listed companies that structure their long-term incentives as a PSP, a performance share plan, and that would usually take the form of a nil cost option, so an option with an exercise price of nil, but then have performance conditions measured over 3 years, and often subject to a holding period after that. There are tax-effective structures for long-term incentives for listed companies too. Smaller listed companies can use EMI just as private companies can, and there's certainly a lot of AIM companies that do that. Where that's not available, so for most larger listed companies, common structures would be things like joint share ownership plans or JSOP, which would deliver a similar structure to a PSP, but with rates of capital gains tax being payable rather than income tax. Or sometimes for a VCP, for a value creation plan, we see subsidiaries of the listed companies issuing growth shares that flip up to listed topco at vesting. There's lots of different structures that you need to think about and that offer different pros and cons. In terms of who we should incentivize, I put on that slide the two extremes. So some companies will just incentivize 2 or 3 executives. Others will incentivize absolutely everyone in the company. And then lots of companies obviously fall between those two extremes. And I think when you're thinking about who in your company you need to be incentivizing in your non-exec role, one way to approach it is thinking about how can you get the best bang for your reward buck, which it tends to then focus on, well, who can move the dial on performance, which if our objective is to achieve an exit or to grow profits, which of our employees can achieve that in a material way. And that approach can lead to concentrating incentives in a relatively small number of executives, although other companies do that analysis and think that a wider pool is appropriate. In addition to that impact of incentives approach, companies will often consider the values and the ethos of the company, and some companies for those reasons want to allow all employees to participate, to feel valued and to benefit from the uplift. I don't think there's a right answer on how wide you draw participation, but it's certainly something that's a relevant issue for a lot of companies. And then finally on quantum, it's probably one of the questions I'm asked the most is how big should the awards be? We want to grant options, we want to give shares, how many should they get, what size should it be? Sometimes it's a straightforward question to answer, other times it's virtually impossible. And how you might think about award sizes as a non-exec if you're looking to incentivize your management team or your wider workforce. In private companies, the starting point is often a percentage of equity. Maybe we want to give the managing director 5% of the equity, for example. And I think that's fine, although I'd also encourage you to think about it in pound note terms too, in terms of, well, if we did that and we achieved an exit of however many £1,000,000 it might be, what would that mean in pound note terms for the executive? That's important in terms of ensuring that the quantum is appropriate, and also helps when you're communicating the scheme to the exec to explain what it might mean for them. As well as a straightforward percentage, we often see more levered schemes. So that they may involve ratchets, and particularly in PE-backed companies, but also in others, and they may involve hurdles where employees participate at higher percentages at higher values. In a listed company, quantum, certainly for a performance share plan, is generally driven by a percentage of salary. So you have an annual award based on a certain percentage of your salary delivered as shares each year. And that's much easier to benchmark because there's plenty of data out there and they're more comparable. So certainly listed company benchmarking for a non-exec is a lot easier task than private company. Negotiation, sometimes you're going to get execs push back on the size of their awards, want more, and to be able to deal with that situation as a non-exec, you certainly want to have the appropriate modelling to be able to understand the levels of payout that the incentives could deliver. And then finally, investor expectations when we're talking about quantum. Not just in a listed sphere where we have investment association principles of remuneration and we have views of individual institutional investors that will be relevant for your companies, but also in a private company setting where it's, as a non-exec, being able to understand how much equity the principal shareholders are willing to give away and what they expect to be achieved in return for that. So that's hopefully a very high level overview of the sort of way to frame thinking about reward for non-execs. And I'll hand back to Fiona now to lead us into the panel session.
Thank you, Martin. So the plan now is to go through a series of sort of fairly typical questions, but if you have any further thoughts or further points that you want to raise in connection with this, don't forget the Q&A. So if we start off with the first big question, and I think this is one of the big questions that we start, how big do incentive awards need to be to motivate key staff? and how big should they be from a shareholder perspective? So we've got two conflicting views potentially here. So how do we resolve the interests of the shareholder and the interests of the key staff? I know you've just been doing the speaking, Martin, but can I start with you on this one?
Yeah, sure. So I think in a listed company, it's pretty easy to understand from an investor's perspective what they expect, and we've got good data. You know, we might know that in the 4250, PSP awards are around about 200% of salary, on AIM more like 100%. But it's much more difficult in a private company context, and I think that's where it comes to thinking about what the values of the payouts might be. I think the challenge for a non-exec really is to get into the heads of the execs or any other employees achieving awards, and trying to think what size of award is going to be meaningful for them and is going to excite them, going to inspire them to push forward without being excessively generous. And I think that's where some modelling work can be massively helpful.
James, how do you go about dealing with these sort of issues from the sort of investor perspective?
Yeah, I think it helps to have a portfolio where you can benchmark some of this as well, because you get a feel for different remuneration packages across different levels of the senior team. So we always kind of fall back to that as a way of kind of setting remuneration from in terms of our portfolio companies. I think that's a really helpful measure to use. Yeah, and I guess it's just finding that balance between remuneration in cash terms and equity ultimately. And I think there's the question that we come on to around that I can add a bit more colour.
And Richard, on the as a chair, you probably need to do the balance between the interests of your key team and also the shareholders. What sort of issues do you find?
Yeah, I think it's an interesting one in that, I was surprised at how, first of all, one size doesn't fit all, and I think there's a lot of emotive elements as soon as you start talking about executive packages, and we've all seen some of, frankly, the obscene amounts that some people are getting for just doing the day job, but I've tended to find at the smaller end of the spectrum with companies where, let's face it, cash is tight, but these tend to be growth companies. Investors are usually relatively open to the idea of suitable awards being made if it's against proper achievement. And so I would keep coming back to communication. That's with the investors, so that the investors, when they put their money in the first place, they know what they're investing in and they have that alignment of growth expectations. But also with the executive and the staff, we haven't talked about the spread so much, but also to make sure that they are on the same page. An option scheme, for example, which is hugely out of the money, is actually quite a demotivational tool to use. Whereas if there's some expectation that they'll get something out of it, then it's good for everybody there. So going to the question there, how big should it be from a shareholder perspective? I think they have to look at the totality of what's trying to be achieved there. And how do you motivate key staff? Make it an appropriate scheme that they buy into as well, I would say.
I think that's a really good point, Richard. And I think focusing too much on the potential size of the awards can be unhelpful. The question is, what performance criteria do you need to hit those to get those payouts? And if we look in listed companies, we've seen the payout levels for long-term incentives drift downwards over a period of time because there's increasing expectation that the performance conditions will be very challenging. And I think both in listed and private businesses, shareholders are very amenable to large payouts where management have delivered results for them, whether that's an exit in a private company or share price growth in a listed company. So I think it's just about avoiding the old rewards for failure concept and making sure that any awards that are paid out are fully earned and fully deserved.
Okay, thank you. So there's a few points raised there that are very interesting. If we go on to the next question now, perhaps. The next point for discussion on the next slide, I think, is what sort of performance conditions should be attached to incentive awards? Should these always be tied to corporate performance, or should there be individual and or ESG elements? Perhaps, Richard, if I could start with you on this one, particularly to consider ESG.
Yeah, you know this is one of my interests, don't you, Fiona? Exactly. I mean, this is something that did come up on the QCA panel when we were talking about the rules on this. And obviously, ESG is hugely topical at the moment. And, you know, James, I'd be interested very much to hear James's views on this with the sort of companies that you invest in, James. The ESG, I think most companies now most investors are expecting some kind of ESG statement for the companies in which they invest into to be displayed, and so it's clear on that side. If you're going to make ESG one of the performance targets for an appropriate payment out, I was impressed at the shareholders on the panel that we were on, saying, because I said to them, well, does that mean that if the share price goes down, or if profits are not made, will there still be a bonus payout if ESG performance criteria are achieved? And every person did say yes, they should be, which I thought was interesting, because of course most of these things used to be all about total shareholder return, or, you know, financial elements. There seems to be a movement towards recognition of these things. Now, how you measure them, that's an interesting one. If it's a manufacturing company, then obviously, you know, reducing your CO2 outputs or something of that nature. But if you're a service industry, I don't know, bottling your own water in the office is maybe not the same sort of thing. So I think it's one of these things. It sounds good. It's how you actually tangibly measure it all as well. But clearly, the fund managers are being pressurized by the people who put money into their funds to have some kind of recognition of ESG. And so if they are investing into companies and those executives make it more attractive for them to get into, well, then clearly there can be an element there. I think it's still early days. I'm not sure exactly how they're all coming on, but we're all looking at this quite closely on the boards that I'm involved in.
Thanks, Richard. So James, have you come across many companies wanting to put in environmental, social and governance elements into the performance conditions, or what do you see being the most common performance conditions?
I mean, not necessarily, Fiona, to be honest. We've not seen that link applied, you know, just yet into the companies that we invest in. But our, you know, a core focus for us at Palatine is to promote the ESG agenda, and the idea behind the impact fund was to take that focus that we've had on ESG just one step further and invest in companies that we think, you know, have that, you know, something in relation to that as their core purpose, i.e. an impactful company. But in terms of linking ESG elements to incentives, I'm not sure that's really necessary. I think our view on ESG within a business is more holistic, really, and we view this as something that business should be doing and promoting anyway, rather than kind of linking it to an incentive per se. You know, as well as being the right thing to do, ESG is ultimately a way to create value, you know, by reducing energy consumption or reducing waste, for example. So our view is that ESG is really just another lever that you can use to drive corporate performance, to be honest.
Sorry, can I just jump? James, that's exactly the point, and I agree 100% there. I think, you know, we can, if we're not careful with ESG, we can get too much focused on the E side, you know, as I say, driving down CO2 or something. The social responsibility and the governance aspect are reflections of well-run companies anyway, and companies should jolly well be doing that anyway, so to speak. But as I say, I suppose I was looking at it more where there's a specific target, such as, you know, as I say, if you're a fizzy drink manufacturer, if you're trying to bring down the amount of sugar that's being consumed, or disposing of bottles, or CO2, if there's a particular target you're trying to reach, that maybe you can put that element in. But yeah, I'd agree with you. It can be a fuzzy area if you're not careful, and the problem with that is then it becomes more subjective, doesn't it, rather than objective in attainment of those requirements.
That's a really interesting point that you just raised there, the subjectivity and the objectivity. Martin, do you find it sometimes quite difficult to translate desirable performance conditions into legally binding words that will actually work in a say an option agreement?
It can be tricky. I think there's certainly the increased use of ESG related performance conditions is part of a broader move over time from using solely financial performance conditions, like solely TSR and nothing else, to taking into account other factors. And that's not just ESG, that's also strategic performance conditions of a subject nature tied to the long-term business plan of the company, and also personal performance conditions. I think there's how you, as a non-exec, how you set those performance conditions is incredibly important, not just in terms of whether they're legally watertight, but also in terms of what the expectations and understandings are of the person who's receiving that award. Because what you can sometimes get is, if it's not sufficiently clear, if it's not sufficiently transparent, then when we come to assess the performance condition at the end, we find out that the recipient had a very different understanding of how it was supposed to work than Remco or the non-exec, and that can lead to a falling out or ill feeling. So thinking through those subjective performance conditions very clearly and communicating them sufficiently to the participants is really important. I think Richard also raised an interesting point around whether awards should pay out on the basis of ESG conditions, ESG performance conditions, regardless of financial. The alternative way of doing that that's been around for a long time for broader subjective performance conditions or non-financial ones is to use them as an underpin. And so even dating back 10, 15 years ago, we had oil companies with health and safety performance conditions where their LTIPs couldn't pay out if they breached certain health and safety rules. But that wasn't actually determining the size of the payout. That was more determining whether or not they were able to pay out based on the financial criteria. So there's different ways of approaching it depending on what the nature of the performance condition is. But I certainly think it's something that boards should be looking at closely. I think with all these trends, we tend to see them start in the FTSE 100, then permeate down through the rest of the main market, through AIM, and then to some extent to private companies as well. But I think certainly in AIM companies that I advise, I'm not seeing huge use of ESG performance conditions just at the moment, but I know they're a lot more prevalent at FTSE 100 level.
Thanks, Martin. I think the next question is also related to performance conditions. Flicks up. Oh, it's not. I'm looking at a different one, obviously. How can an NED deal with an executive that demands a larger award than they consider warranted? Oh, well, this is quite a difficult one, isn't it? Richard, do you mind if I start with you again on this one?
Yeah, once again, I think this is an interesting area. I've actually had the opposite situation, that I actually try and award more to the executive than they're expecting sometimes, which we shouldn't be worried about. I think that there is this perception that executives are, grubbing and grasping and what have you. And I want to make it attractive for an executive. And I think it's getting everyone on that same page. The investors absolutely to buy into it while we need to do it. Clarity. I'm not sure what one of the panelists mentioned about clarity of understanding, because I think it was Martin saying, make sure everyone understands what's going on. And I think on this one, it's making sure that the Remco, if there is a Remco, has sufficient teeth to speak with authority and to agree something there that everyone buys into. It helps immensely. The biggest element here, of course, is the threat that somebody will walk away, and I suppose part of that is also succession planning and how appropriate remuneration schemes should not be focused on just one individual who gets, say, 5% and the rest of the 5% dribbles down to everybody else. but to ensure that there is that team ethos there that's to do it. But I'm not so worried about larger awards. I'm more worried. I'm keener to ensure that there are appropriate awards, and awards that will not surprise surprise everybody, including the investors.
James, have you had any situations where you've seen this?
Yes, I guess is the simple answer. I think for me, it's understanding the strength of that executive's position. I suppose, yeah, how do we rate that person? Are they performing, and is that demand part of a kind of a wider reset in terms of looking at their equity versus remuneration package? And just as I think, as long as you've got alignment going forward with that, then it's about a negotiation, isn't it, to find the kind of the sweet spot within all of that. That might be warranted, I suppose, in terms of receiving a larger reward. You might need to have a look at the equity structure of the business, or the current options in place, or whatever that might look like. But I think you've got to just approach that with pragmatically, really, just try to cut through it, depending on I guess the strength of that position, the strength of position that the executive sits in, really.
Thanks. I guess, Martin, when you're advising RemComs, this is a factor you need to take into account. Although often we're a little bit limited if we are advising companies where we also audit, so it's a bit difficult sometimes in terms of quantum.
Yeah, I've seen the issue raise its head a few times over the years, not hugely often. I think one starting point is it can depend on how independent the remuneration committee and the non-execs are from the directors. So I certainly have a number of clients where Remco is very independent, very strong, and they will reach their decisions on what the execs are going to get, and they're happy to have a debate on it with the execs, but they will stand their ground if they think they're in the right. And that's, I think, part of the role of a non-executive director, is not always to say no to the execs, but to be willing to stand up to them to act in the best interest of shareholders where that's appropriate. And I've certainly seen examples of that happening. Sometimes we've had incidences of non-execs being approached by one of the executive directors and either wanting a larger equity award or larger bonus potential, or equally an increase to their base salary. And that's where it tends to be benchmarking that we can do to help that non-exec have that discussion with the exec, because the exec is almost invariably going to be saying, I could be having a larger slice of equity if I was elsewhere, or I could be having a higher base salary if I was elsewhere. So part of the non-exec's role to assess that has to be to understand, well, what's the reality of the market at the moment. One approach I've seen adopted sometimes when executives have asked for bigger slices of equity or bigger awards is to almost go back to them and say, well, if you're going to back yourself, we'll do that, but we're going to set a higher threshold where that award kicks in. So let's say you had I'll talk in percentage terms for a minute. Let's say you had a managing director with 5% of the equity. That was what was on the table for him being offered, and he wanted more. You might say, well, okay, we will give you 10% of the equity, but only above a certain equity value hurdle. And so you're basically saying, well, okay, there's the potential to earn more, but you really need to deliver in terms of what you're going to do to grow shareholder value to be able to get that. I think that can be a good way to approach the conversation, rather than it just being a case of increasing the percentage or increasing the number.
Yeah.
We've also sometimes seen, sorry, Richard, nearly finished.
Yeah.
We've also sometimes seen executives dealing with quantum issues through pressuring for better tax structuring, and executives obviously focus on the net receipt they'll get in their incentives, and sometimes they can say, I'm not happy about it being structured this way, which is very tax inefficient. Can we do something better so that at the end of the day, if I perform, I'll get a higher amount in my pocket?
Richard.
Yeah, I'd agree. That's absolutely. I'd agree with all that's been said there. I do think that a lot of this though goes to the authority that the NEDs have, and things have changed enormously. I think in the last 10 or 20 years, where the NEDs are now seen to be much more independent and have to be independent. But that also means there's more responsibility on the NEDs, and sometimes you think, who would want to be a NED? For that sort of responsibility. The more that it's possible to refer and get independent advice, Martin, Fiona, whoever, the more it helps the NED to do it. And also, I think the more the NEDs have a rapport with the investors, I would say then their power base is much more balanced. If they're just there because they know the CEO, well, that's not very good corporate governance. I've always tried to have a good rapport with investors as well, and hopefully the investors could pick up the phone if they have a problem with these things, but it can't be done in isolation. And so to be able to have some kind of access to objective criteria and also access to all the stakeholders ensures that the NED is in a better place to have those trickier conversations, shall we say, with the people who are on the executive, I would suggest.
Yeah, I mean, that's a good point, and external advice helps. There's only one problem that I sometimes have is when you're benchmarking and you identify that somebody's on the third quartile down, and nobody really wants to be less than halfway up, really, do they? And that can sometimes be a tricky one to actually to discuss with an executive. But I guess there's always things that you can do. You can swap, maybe a lower salary for more awards, share awards, or other benefits. Do you find those sort of arrangements work?
Yeah, I think the trouble with the quartiles is that it's too. People just look at the quartile and say, well, I want to be in the upper third of it or something, and it's the lazy thought process. I always like to look at the bigger picture. What do you want to try and achieve with that? And then by all means you can look at the most effective and what have you, but what is it really trying to get to as well?
Yeah, thanks, Richard. Okay, if we maybe move on to the next question for discussion. This is an interesting one, I think. So should companies worry about employees leaving en masse after an incentive scheme pays out? This is often where they pay out on a particular event, like an IPO or something of that nature. And how can this be avoided? And also, how do we treat leavers? I think those two questions are also aligned. Martin, how do you deal with this in terms of designing a plan in the first place?
It's actually a really common concern raised by particularly founders and shareholders in private businesses, which is that they've got their management team in place to help them deliver the next leg of growth, to help them deliver the big exit or the IPO. They know that they need to incentivize them, but what they're also conscious of is when a buyer comes along, if their management team are getting huge payouts all at the same time, then the buyer may be concerned those managers are not going to stick along because they can just head to the beach. So I think when that issue is raised, I think the first of all point to consider is first, is it a realistic risk? So that is going to depend on the quantum, really. If it's a modest size incentive scheme, then it probably isn't a real risk, and we don't need to worry about it too much. If it is an incentive, if it is a risk, if the size of the payouts could lead to that happening, then there's various things we can do. So a common structure would be to have an element of retention, so that some of the consideration is held back for a period of time after the transaction or the event that causes the awards to vest. There are also another approach is if it's not an award, if it's not a scheme that's based on a particular single event happening, then you can have annual awards which vest every year, and that's then going to mean that at any point in time, an employee always has a certain number of years awards locked up, if you like, which can be a retention tool. I think on the transaction issue about whether a buyer is going to be concerned about it, I haven't seen that buyers concerned about it that as often as shareholders and vendors think they're going to be. And I think that's usually because buyers will almost invariably have their own ideas about how they want to incentivize the key people after the transaction. And if that's a PE house, maybe it's sweet equity, or if it's a different type of buyer, a different form of equity incentive. But I've often seen, even where we've put in some kind of retention or withholding type provision, that buyers have not actually wanted to enforce that because they've said that's fine, we'll deal with it in terms of our post-acquisition structuring.
Thanks, Martin. As an investor, James, have you ever had a situation where you've come in, there's been an exit as you've come in to invest in a company and people have left?
Yeah, I mean, it tends to be linked to the conditionality of our deal structure, I suppose. Fiona, there are key people that where the exit that forms the purpose of our entry, where there's a crystallization of value there, we would be looking for key people to perhaps roll some of that value into a new co structure. It depends on quantum, doesn't it, and how that then links to that individual being potential flight risk and equally their importance to the business as well. But we'd have some conditionality in there. If there's a substantial sum being taken off the table, for example, then we'd need to see some of that rolled over into the new co. For obvious reasons around retention and incentivisation going forward. So I think it depends on the individual, depends on the quantum, and depends on their role in the business going forward as well.
I often find that if at the start you can try and do a bit of modelling and sort of do some anticipation of what is going to be values on an exit, whether or not you can at that stage structure something to ensure that it falls within sensible boundaries so that somebody is well paid, but not necessarily retirement for life scenario. Have you, I'm going to turn for you, Richard, to maybe that sort of last question, which is how should we deal with leavers? I mean, should leavers be allowed to keep? Should leavers have a limited period? What do you tend to find works best?
Well, I think obviously here we're talking about good leavers and bad leavers, and whether they're going to participate any longer in what they're doing. I think if they've done what was agreed and and they're entitled to it, well, good luck to them, so to speak. The fuzzy bit, I suppose, is if there's been an award and then they leave and there's been some kind of malfeasance, and whether there's any clawback element on those sort of things, which is something which a lot of the newspapers tend to headline at times, but from a legal point of view, it's quite hard to structure those sort of things as well. My feeling is if somebody has left, I'm more interested in the people who are still in the business and ensuring that you have that spread of interest across the people. Leavers are going, that is part of it, but ensure that the king is dead, long live the king, so to speak.
Thanks, Richard. So just Martin, following on from that, Richard raises the question about clawbacks and malus clauses as well, where you can adjust awards post vesting. Are you finding that companies are more interested in those kind of arrangements these days?
Yeah, I think in listed companies they're almost universal now. Very high percentages of companies have malus and clawback, and in fact over time the criteria for what could trigger a clawback of an executive's payout has widened somewhat. There's not huge use of them in practice, so I think that there's certainly a view among some that they're to some extent window dressing to say we've got malus and clawback, but in practice, as Richard said, they are difficult to use. It would be very contentious. And if you're talking about claw back a cash amount that's already been paid to an individual, that's obviously very difficult in a practical sense to get that money back. And so deferral is perhaps easier, because then you're deferring payout of the award for a period of time to make it easier to recover that if wrongdoing emerges, and also then further linking that individual's financial prosperity to the ongoing success of the company if you're keeping that retention in shares. So I think malus and clawback is important, and I have seen it in some private companies as well. But I think it's not a substitute for well-designed performance conditions.
Thank you, Martin. Shall we move on to the next question?
Can we just touch on levers a bit more, Fiona, as well, before we go on?
Sure. If
Yeah,
there's a little bit more you want to mention.
I think that's definitely, so Richard gave the perspective on levers from, I think, largely a public company perspective, and I think we see quite a different approach to levers in private companies, where I would say the vast majority of private companies putting in place long-term incentive plans will have lever provisions that essentially mean if you leave for almost any reason prior to an exit, your rewards will lapse. You do see good lever, bad lever distinctions, but good lever tends to be very narrowly drawn, certainly in private equity-backed companies and in a lot of private companies. And there's a lot of sense in that, because with those type of share schemes, unlike a listed company, with those type of share schemes, it is all about being able to retain someone until they can achieve an exit, and then they share in that value. And if they leave before they've achieved that exit, then they don't get anything. Where we see a bit of variance, though, is I think the US influence. And in the US, it's much more common in tech startups to have options that vest on a monthly or quarterly basis, and if you leave, you keep your vested options. And I've certainly seen some tech businesses I work with in the UK starting to adopt that US approach, where employees are starting to expect that if they do 2 years at the company and leave and an exit doesn't come for another 3 years, they still get to keep their options to eventually cash in on an exit. So that's an interesting slight cultural change coming from the US, I think.
Yeah, no, that is very interesting. The monthly, quarterly vesting does seem particularly popular amongst US arrangements. The trouble is they don't always translate into the UK, because unless they've made certain elections, you can then end up having all sorts of difficult tax positions as they come and vest on a quarterly basis, depending on the nature of the particular award. But that's straying slightly beyond the question here. Do you have any final points that you wanted to raise, particularly about levers, James?
No, I don't think so. I echo Martin's comments around it. Really, the provisions around good levers and bad levers are very kind of carefully negotiated at the outset of a deal. So you respect those in the event that actually happens. Ultimately, if somebody leaves and they've got equity, you're going to need a proportion of that back at least, because you need to incentivize the replacement. So you've got to think about the people coming into that structure as well as the person that's leaving.
Yeah. So now maybe if we move on to the next question. Right, so where have you seen incentives plans go wrong? And I'm also going to bring in a question that's been raised by Nick Hanlon, who says, given remuneration is typically intrinsically been linked to an uptick in performance measures, how do you incentivize performance during an unforeseen shock, such as COVID-19, but also, I guess, unexpected downturns, economic downturns, and successfully helping steer the business through to the other side? So perhaps if we can look at where they may have gone wrong, but also where external factors have made things go a bit wrong. Martin, have you seen anything of this nature?
Unfortunately,
not
you
the plans you've put in place.
no, of course not. No. But inevitably, you do see incentive plans go wrong for a range of different reasons, really. I think one of the most common ways they go wrong is quite mundane and not too dramatic, but actually is pretty tragic if you're a company putting an incentive scheme in place, which is that company decides we want to implement, let's say, a share option scheme. They get the documentation drawn up, get the documents signed, sent to people, and then it just sits in everybody's drawer. People forget about it. They didn't really understand it in the first place. They don't really know what it means to them. They don't really understand how they're going to realise value for that. And really, it was a waste of money and time and effort putting that share scheme in the first place. And that's actually a really common situation for companies not to understand their own share schemes. Even I met countless FDs who will say to me they just don't really understand the way their share scheme works. And I think that's a massive lost opportunity, because the whole purpose of doing an incentive scheme is to change the behaviour of your employees, to influence their behaviour, to get them to do something you want them to do or not do something that you don't want them to do. And that then comes to the communication piece. If you're going to put a share scheme in place, if you're going to be giving away some of the equity that belongs to the shareholders, you need to explain that in a clear way to the employees so that they understand it and so that they value it, because otherwise they can be pretty indifferent to the long-term incentive plan you've given. So it's not dramatic, but it's so common, and I think it is a big problem. The more dramatic places they go wrong, it tends to relate to tax, unfortunately, in that share schemes in particular, share incentives, is an absolute minefield in terms of the tax law. And regularly looking at share incentives on transactions as part of my work, it is on so many transactions one of the major due diligence issues, the share schemes, whether that's a formal share scheme that hasn't been drafted correctly, so it doesn't meet the requirements of the tax legislation, or whether it's just that management have been issued shares without considering the value of those shares. So was there a tax charge? So I'd say there's a huge amount of value that can be got from long-term incentives and share plans, but there's also a huge amount of risk if you get the structure wrong or you get the tax wrong, and it can give you a world of pain on an exit if you're a private business and you haven't got that sorted out.
Yeah. James, have you seen incentive plans either go wrong or perhaps not quite turn out as expected? And I suppose also I'm interested in how investors see things where there is a dramatic change, COVID, whatever, that means that performance conditions perhaps have not been met as were anticipated.
Yeah, I mean, taking the second question probably first is probably easy. I mean, does an event like COVID change an incentive plan that you got in place? No, probably not. I mean, the ultimate goal is still around exit, isn't it? And achieving a certain exit value and supporting a plan that gets you there. It's more that probably delays the plan, so moves it to the right a little bit. And I think there it's just making sure you've got the buy-in from the rest of the team to understand that that exit horizons perhaps have moved out slightly as a result of that. But ultimately the end goal and the incentive is still in place, isn't it? And ideally, the quantum of that goal remains unchanged, because as an investor you still have a target in mind in terms of where you want to get to from a returns perspective. So that remains aligned to the quantum that has been articulated to the people that are participating in that incentive plan as well. So I don't think it changes. I think the impact is more on timing than the plan itself. On that point, just covering off your first question around where things have gone wrong, I guess echo Martin again. Really, tax becomes the complication. So where you put a plan in place, and it's been clearly articulated to the recipients of it around the tax implications of it, but they don't perhaps understand that at the time, and then once that crystallises, it's suddenly a surprise in terms of the tax implications of that. As I think Martin said at the beginning of the call, where we have a majority position in our portfolio companies, we can't put the kind of EMI scheme, the EMI option schemes in place, which are much more tax efficient and sometimes have to go up for unapproved schemes. I don't know, there's a question on that which we'll come on to, which are less tax efficient. You can communicate that to the recipients of the plan at the outset, but it can still come as a surprise and disappointment potentially once it actually crystallises. So that is where I've seen it kind of come apart a little bit in the past, and then again around the value at which you're granting actual shares as well. That can cause problems when it comes to exits as well.
That's interesting. That seems to reflect the point that you raised, Richard, at one of the earlier questions, is in connection with communication and the importance of that. But how do you see incentives, and when what do you do when you notice that plans are starting to go in the wrong direction?
I would share James's comment there very much, that there's a buy-in there. If investors have put their money in, they've got their expected returns on it, and you don't keep chopping and changing those aspects for external factors unless it's remarkable. But what I was surprised at was, I've always taken it as verboten, not allowed to actually rebase options, for example. When we were on the panel, I was surprised at how investors felt that that if the targets are no longer appropriate, and also if it's to reward people who have not been there, actually that isn't necessarily, but how you can rebase option schemes. I think the key thing is, whatever you're going to do, communicate with the investors rather than just giving them a surprise, and have a private round and talk it through with them. Often if you're talking about it with investors, you'll know if you're talking turkey anyway, and it doesn't make sense, and it's getting that partnership in the right sort of way. The other area where I've seen incentive plans go wrong is they get, and this was Martin's point, wasn't it, earlier, they get so complicated, people kind of lose track of what you're trying to achieve. A lot of these arrangements, if we keep it simple, then the executives and the staff know what the rules are, if you like, but also the wider investment community know it, and keep it simple on that basis, rather than a short-term tax saving to do it in one way can quickly go out of date, where you've got to be flexible on it all. I suppose it comes down to communication. That's the key thing, and having an open dialogue, so with both staff and investors on it.
I suppose if the simpler the plan, the easier it is to write your REMCO report for the year as well, isn't it?
Yeah, you can keep it shorter. Exactly, Fiona. Thanks. Yeah.
I think the issue about the external factors, so COVID-19 is in Nick's example, but it's something that we see in every economic cycle. I can certainly remember a lot of companies looking at this after the financial crash 10 years ago or so ago, which is that for some companies, their incentive schemes will just become totally unfit for purpose because of something that was not under the control of the management team, or where you had the management team change and the new management team weren't responsible. And that's not just option repricing particularly in a listed company, but also in a private company where you've got management holding equity and there's a lot of debt in the structure. Maybe it's a PE-backed company. That equity can become heavily underwater, and if you let's say you've brought a new management team in and you want to issue them equity, if the company has to grow in enterprise value by tens and tens of millions of pounds before that equity has any value, that's just not a very powerful incentive to that new management team. And so inevitably in those kind of situations, we work with businesses to try and create a structure that's appropriate in the circumstances to genuinely incentivize management rather than offering them a worthless piece of paper that their first couple of years of work, even if they do fantastically, is going to be unrewarded. But I think I wouldn't jump to reprice options. I wouldn't jump to rebase share schemes, but sometimes it does need to happen.
Okay, that's interesting. Okay, let's move on to the next question because we've still got a few to discuss. So this was touched on a little bit by Martin in the last question. So is it worthwhile looking at approved share schemes? They used to be called approved share schemes. Technically, they are now tax advantaged share schemes and other complex structuring. Or is it easier just to use unapproved options and cash? So Martin, I will start with you on this one because you kind of raised it beforehand, and I think this is a tax issue.
I don't think we've heard enough from you, Fiona. I'm going to hand it back to you to have a first answer on this one.
Oh, thank you, Martin. Okay. I'll tell you what my view on this is. Approved plans or tax advantage plans, we're talking about CSOP options with a maximum limit of 30,000. We've got SAYEs and also share incentive plans, which could, in their own right, give a benefit of £30,000 worth of shares each. And we've also got the EMI plans, which are the very special plans, but they only work for companies with less than 250 employees and 30 million gross assets and a few other tests, which will actually give you up to allow you to have shares with an original cost of up to £250,000. So they all give you wonderful tax advantages, maybe after 1 year, maybe after 5 years. They all have slightly different rules. And the point is they all do have slightly different rules. They're not necessarily complex, but they can sometimes be a bit fragile. So if you implement something and then you decide you want to restructure a group for whatever reason, you've then got to do a whole heap of other things to make sure that you either retain your tax advantages or whether or not you take the view that it will just come to an end and you will lose them. So they can be wonderful or they can be awkward. And so I think sometimes you do have to say, well, does it matter if we use something that does not have tax advantages and you end up just having to pay tax on it? Now, tax can be particularly nasty, particularly high. You could have 45% employee tax. You could have then 2% national insurance for the employee at the moment, but we know that's going to go up to 3.25%. And then we've got the employer's national insurance, which might possibly be put on to the individual because that can sometimes be allowed. And that's currently 13.8%, but it is going to go up to, and I think I'm going to get this right, 15.05%. But if I'm wrong on that, do tell me because I haven't quite memorized it. So we know that that's all expensive, and then you've also got the apprenticeship levy. So it's not that there isn't a lot of tax if you go for cash or non-qualifying options. But on the other hand, if the idea is that you're only going to benefit, well, you will get value out of this. You can't be taxed normally. You can't be taxed unless there's some value being received by the employee. In that scenario, do you say, well, you know, if it happens, and you get taxed on it? I can see that it works both ways. And I do take the view that if something is going to be ridiculously complex, then let's just not bother, because the cost of implementation, the costs of maintenance and all of that, and the restrictions on the company from ensuring that it does meet the continuing approved status could just be unnecessary. On the other hand, there is a difference between it being taxable if you get something or some penal taxes that can arise as dry tax charges that can arise before you actually hit any benefit out the other end. And that is something worth exploring and making sure that you don't have that as a problem. So that's my spiel.
Can I just ask, Fiona, is there any stigma against unapproved? You know, if it's approved, and this is a question I must say my main experience is with unapproved options in cash, keeping it simple. But is there a perception that approved are more, I don't know, holistic is the wrong word, but you know, cleaner, more appropriate than unapproved?
I think that's an old-fashioned approach, because once upon a time plans were literally approved by HMRC.
Yeah.
So employees could feel, well, that's government approved, therefore it's not designed to rip me off in any way. And there's probably an element of truth to that. For example, if you've got an approved plan, you have to have objective performance criteria. You can't have subjective performance criteria. So maybe there's something in that. But we often get asked the questions, and I'm sure, Martin, you do too, is, well, how come there's so much tax on this? What do the FTSE 100 companies, how do they avoid tax on this? And the answer to that is, well, they don't. You know, unfortunately, the schemes, the LTIPs or whatever in the large companies are typically taxable. They just are avoiding the nasty incremental taxes, which you might get from, say, restricted securities. They avoid all that, but otherwise they are taxable. That's what I find, anyhow. James, most of your plans presumably would have no tax advantages.
Yeah, well, it's a bit of a mixed bag, I suppose. So we do minority investments where our shareholding is less than 50%. So in those circumstances, obviously, we're more than happy to put the approved share schemes in place where we can. I guess in those circumstances where we've got a majority holding, then the options are obviously far more limited, and then it's for us it becomes a question of whether you put an unapproved scheme in place and kind of you pass on the detrimental tax impact of that onto the recipient, or whether you just look at actual shares. And it's usually that debate that we have kind of at board level in terms of whether that individual should be, you know, what's their level? Should they be more akin to a kind of an option position, or should we elevate them into the actual share structure of the business immediately? Yeah.
The other thing that I see is that even if that sometimes the tax position can be addressed through modelling. So again, through kind of identifying what the potential payouts would be, what the potential tax would be on that, and also what the potential cost for the company could be. Because yes, income tax and national insurance is fairly high. Corporation tax is fairly low at the moment, but again, we know that is going to increase. So if that goes up to 25%, quite often you will be able to get a corporation tax deduction through the company, and that may balance out some of the costs, even if it doesn't get the tax advantages by getting a corporation tax deduction at 25%. So it's fairly mixed on that. Any final points on this? Okay. We are in theory finishing up on our time allotment for these discussions. Can you just roll on to the next couple of questions so we can see that? Can I see that next one as well? Because I'm not sure what I printed out. Maybe I can just ask you to just, James, if we go back onto the PE question and just see how you find incentivisation in the context of private equity transactions.
Yeah, no problem. Yeah. I mean, in terms of the importance of incentivisation within a PE deal. I mean, it's an absolutely crucial element of how we structure our deals. So the importance is clearly very high. I mean, in a typical deal, we obviously, we obviously ensure that the key incumbent management shareholders are rolling equity into the new structure, as I kind of touched on before, just to make sure those people are properly retained within the business and properly incentivised. But equally, it's also an opportunity to bring new people into the equity structure as well, that it may be up to that point might not have had the opportunity to participate with shares. It's essentially we're backing management teams to deliver on a plan and grow the business that will ultimately deliver a financial return for everyone. So getting the incentivization right around that is really important. And a big part of our structure is just to make sure all key members of the team are included in that, so that we have that really strong alignment going forward from the outset, and the shared goal of creation of equity value. So we'd always try to create some additional equity within our transactions, sweet equity pots and the like, to incentivize key members of the senior management team. And then as you move through the investment cycle as well, new people will step up into that within the business, or might be recruited, for example. And we'd always continue to view equity as the best way of incentivizing those individuals as well, whether that's through shares or share options. And I think finding the balance of that alongside just general salary remuneration is also really important. No issue with significant levels of bonus where that's linked to over performance and growth, but it's also got to drive the right behaviours in the business, and not be too focused on the short term, given we're looking at a growth plan over a 3 to 5 year horizon typically. So finding the balance there is important, and we're always careful not to weight that too heavily towards ongoing remuneration. Just we've got to protect maintainable profit within the business, which ultimately that has a big say in driving exit value. So yeah, we tend to view equity as the more appropriate mechanism there, just to help with that, and just get management teams focused on the longer term and creation of equity value, really.
Do you find there's a bit of a kudos amongst having shares and having an equity interest?
I think it is, yeah. It's often a nice incentive for that second tier team as well, to grow with the business, develop, and ultimately that can be an area where they can grow into. So a promotion into the senior team and an elevation into that equity structure as well. So definitely agree with that, yeah.
Martin, anything you want to follow on from that?
Nothing particularly to add on that one, Fiona.
I think we're going to have to quit the next question or so, because I would like to, obviously, if that's of particular interest to you, how wide do you take incentivization? Please feel free to message us independently, and we'll happily have a chat about that. But I would just like to pick up on a question that I think it's Rashma Yohar. I haven't got my right glasses on, and I've got this up on a bigger screen. And she's asking, that question is all about internationally mobile employees, employees who work between different countries, and how that works, and how you apply double tax treaties or any other apportionment. I just wondered, Martin, if you could just sort of have a go at that question.
Yeah, sure. So international share plans are obviously very common in large global businesses, and there are issues around when you design them in the first place, and then there are issues when you manage them on an ongoing basis. I think when you're putting in place a global share plan at the outset, you obviously identify in which countries you're going to have participants, and then you need to come up with a structure that will work in each of those countries. And the temptation can be to say, we'll ask each of those countries what would be the best way to structure your share plan. And then let's say you've got 15 countries going to be involved, then basically you have 15 totally different share plans that are all tax optimized in each country. I think that's generally not going to be a good approach, because it's going to be not only phenomenally expensive to do, but also hugely complicated for the company to be able to manage on an ongoing basis. What's much more common would be to identify your key jurisdictions where you've got most people, and then try and get a plan that works to a reasonable level in all those countries, is reasonably tax efficient, or at least isn't disastrous from a tax perspective. And then essentially other countries will just have to tag along and accept the tax treatment that the main plan has. On an ongoing basis, there certainly are complexities when you have globally mobile individuals, and particularly where they move countries from between the date of grant of the award and the date of vesting or exercise, and you often end up in quite a complicated analysis of which country that's going to be taxed in, or how it's going to be split between the different countries. So certainly if you've got employees who move countries and who hold share awards, you do need to take advice on how that's going to be taxed, because it is complicated and varies in each case.
Yeah, no, sadly it is complex. There may be an apportionment under the various DTTs, but it does vary which countries are involved and how long people are working in each jurisdiction.
Can I just add something?
Okay.
Sorry,
Yeah.
Fiona, just on that, there's also an element, I think, certainly in the tech space, on the recruitment side, I think there's definitely a different perception on how much people are being paid. You know, to recruit a decent CEO from America, for example, to come into a UK tech company, they have completely different perceptions on what it is, and sometimes there's an education point as well, and also one has to look at it in slightly different ways to make it look attractive as well on that side. So I think it's not just tax; it's also perception of what people are expecting.
Okay. Yeah, that's great. Thanks, Richard. Okay, so we need to wrap up now, I'm afraid. So can I offer to each of our panelists 2 minutes to give us some key takeaways? So maybe if I start with Richard.
Yeah, I would just say keep it simple, spread it around as well a little bit. A few shares go a heck of a long way to make even the junior member, if he's got a few shares or look through, feel that it's his company and that he can buy into it. So and the final thing is, I think communication all round helps.
Thank you, Richard.
Oh, sorry, the other aspect, sorry, the key one for me I made was also there mustn't be an expectation of a bonus for mediocrity. You know, sometimes people think that they're entitled to something when what is the purpose of that? You know, it's got to be earned, I would say.
Okay. That's an interesting point. So that links in with getting the salary right in the first place, I guess.
Well, yeah, that, and also one size doesn't fit all, does it? You know, we know that from as well.
James, your takeaways.
I think echoing one of Richard's points actually around communication. I think it's important to have those strong communication lines in terms of being able to articulate the plans that you're putting in place from an incentivisation perspective with the various different levels of manager, and having that ongoing communication, you know, particularly from our perspective in private equity, where you're going through a 3, 4, 5 year cycle, to maintain that communication throughout and just make sure that you continue to be aligned and people know the goals that you're working towards, just to make sure that the structure of the incentivisation plan that you've got in place remains relevant and remains visible to them, so they can still see it.
That's a good one. Thanks. Martin, what are your takeaways and thoughts?
I think the key thing for me is when you're looking at incentivisation, looking to put in place a new plan, it's about taking the time to think about what the purpose of doing that in the first place is. What are you trying to achieve as a business? What do the shareholders want out of this? And how can we design a plan that actually helps to deliver that? Don't just put in place a vanilla share plan that just doesn't really have any relevance to your business. And then second, which I would say, coming from a tax background, don't mess up the tax on your share schemes, because it will give you a lot of hassle.
Thanks, Martin. I like your reference to vanilla. When a client asks me if they could have a vanilla share plan, please, I like to say, why are you a plain vanilla company? Obviously, they're not. Every company is individual. That's really good. Thank you very much. I think my takeaway from this is that non-exec directors have an awful lot of different issues that they need to think through. not only in the case of incentivisation, but the sort of the broader aspects that seems to bring into place. So I think it's a difficult role being a NED, and congratulations to all of you who do that. Can I draw your attention, therefore, to our future network events? You'll be able to find those if you go to the rsmuk.com website and find the link to non-exec-directors, which is relatively easy to remember. It's one of the things that I can probably manage. It's when you also have QZW/ and all the other rest of it, that then gets a bit complicated. So do have a look at that and make sure that you're fully signed up. And beyond that, I would like to thank you all for joining us today. It's been really good to speak to you.
Thanks very much.
Bye.
Thanks, everybody.
Thanks all.